Good morning, everyone. Welcome. Today's Friday. How you doing? How's everyone doing? Comment below if you're in the house. Let me know that you're here. Today we're going to be covering different infinite banking companies, or I should say different whole life insurance companies that cover the infinite banking concept, or that can help you, design a high cash value life insurance policy for the infinite banking concept. So we're going to be dissecting a few things here. I'm doing this for myself personally, but also for my clients, because I just want to make sure that I have the right information. So I'm willing to make mistakes. I'm willing to be wrong about things. I'm willing to do the research so that you can learn, I can learn, we can all learn, cut through all the noise and go right to the truth, right? So that we can have an asset that will perform, that will do what it says throughout the history of you funding a policy, you maximizing it, utilizing it to the best of your ability, and so forth. So let me just say hello to some people in the house here. Good morning, Billy. Good morning, Plethora. Sharonda, how are you? Ruben, how's it going? Gregory Knight, how's you doing? John says, how is your cash flow? Have you made a resolution to take steps to increase it this year? It's not too late. Cool. I think John's talking to everyone in this case, including myself, I'm assuming. Definitely my goal is to hit 3 million in revenue this year. So that's 10x what I did in 2019. So even if I don't hit 3 million, you can't be mad if you hit 1. And that is a great mindset to have, where you set a goal that's unreasonable. You don't want to set goals that are attainable, that are just, here's a goal and you're right here and your goal is here. It would be better if you set a goal that's like way out here. This way it takes some actual work, some sacrificing, you know what I mean? And so you expand the goal, and you can't be mad at yourself if you don't hit the goal at the time that you want, because it's so unreasonable. It's like it's way out of your comfort zone. But if you set the goal way out here and you're all the way over here and you get halfway, you can't get mad at that, because originally you thought you could only do this, right? About from here to here. So what I've been doing in my life is I've been setting goals that are unreasonable, unattainable in my current state of being, in my current ways. And I say, all right, financially, I want to make 3 million. I never even, it's not that I don't want to make that much money, but it's like I don't even know how. I don't know the strategy yet. I'm thinking about it. I'm making sense of it, trying to make sense of it. Very difficult, right? But that's okay, because I'm like, well, 3 million's all the way out here. I'm right here. My original thought process was, damn, if I can just double my income, I'll be happy, right? You can't be mad. 23 years old, or if you're someone that's in your 20s and you go from 0 to 6 figures in a short period of time, there's really nothing to be upset about when it comes to your financial health and wellness, okay? You're going to get access to a lot of things at a very early age, okay? And even if you're someone that's older, 40, 50 years old, you've made 5 figures your whole freaking life, and then 1 year you just kill it and you do 6 figures. You can't be mad at that. But the point is to continue to increase and not get comfortable at that new stage, or else you'll stay there for the rest of your life just like you were originally. So it's good to set these humongous goals, okay? Good morning, Big. How you doing? JP, good morning, brother. Thank you for answering my question yesterday. You provided immense value. I need to continue researching the theory. Yeah, I remember your question from yesterday. That it was pretty interesting. It's a little scary to me, because there's a lot of things we're not factoring in. and I'm someone that is super conservative when it comes to running numbers. I always lowball stuff, make it look worse, and then actually do better, so I'm happy. I'm disappointed or whatever. Hidden, good morning. Renard, how's it going? All right, so let's talk about the infinite banking concept. We're covering whole life insurance companies. We want to focus on mutual insurance companies. We want to take a look at all the options that are available. And we also want to take a look at who's selling the infinite banking concept, who provides it to the consumer. How does the consumer that is interested in the infinite banking concept, how does that person get access to the right information? Where's the source of it all, right? Where did this thing come from? And how can I make sense of it in my life? Who do I know, like, and trust? A lot of things here. There's a lot of variables, okay? So I've started writing some things on the board here. Trust me, it's not all here. It's incomplete. But with your help, we're all going to do research together. So it's going to be very engaging. I encourage you to open a couple windows up. So if you're home and you're on your laptop or you're on your phone, like, have me playing in the background, but definitely open up some other windows and start just typing in these different companies that I put on the board, and let's figure this thing out. Let's see if we can find articles. Let's see who's talking game, who's the big players in the infinite banking space, okay? So the first thing that I know for sure is, and I'm just going to cover it at the bottom here, is when it comes to the infinite banking concept, there's a couple of terms that people will use in the space of, who sells this stuff. So we have becoming your own banker, right? Let me know in the comments if you guys heard this stuff before. Becoming your own banker. Let's see. Anyone heard of cash flow banking? I've heard the term tax-free bank. Comment below if you know the different terminologies. If you're someone that's looking at the concept, someone's trying to sell it to you. Maybe it's me, that we actually had a conversation. I'm like pitching you a policy to start for yourself. And let me know the terms that I've used or someone else has used. So becoming your own banker, cash flow, tax-free banking. What's the other one? There's some popular ones out there. And I'm gonna do some research. I'm just gonna start typing it in and seeing what I get. Most people say infinite banking or infinity banking. So those are the terms. And then we have the people that are selling it. So who sells this stuff? Who's in the game? Who do I go to? Who do I get to know, like, and trust? So I'll just write the YouTube channels that I've researched and found. So one of them, big channel, is VIP Financial. I think they're the biggest channel that I've seen so far in terms of subscribers and most likely sales and revenue. VIP Financial, I've seen them cover a little on the velocity banking, mostly real estate. They talk mostly real estate, credit, getting access to big credit lines, credit cards to invest in real estate. I've seen that talked about a lot more than anything. But I have seen videos where they bring in a person or an expert and they cover the infinite banking concept. So that's one source. Then you have, let's see, Wealth Nation. I think that was the name of their channel. Much smaller channel, but it's a couple, husband and wife, and I think they just cover infinite banking. That's all I've seen them talk about, and they have plenty of content. Then you have IBC Global, okay? And you'll hear me mention them quite a bit on my channel. That is my referral. When people ask me about infinite banking, I refer them here as a resource more than I would other channels I personally like, right? I like, know, trust. So there's that personal preference, the amount of research and education I received from that individual that covers infinite banking on that channel, IBC Global, has definitely made me happy. So therefore, I refer people that way. Make sense? Cool. Then you've got Nelson Nash, who I would say, from everyone I've ever spoken to, customers, agents, and people on other YouTube channels, have really given this man, Nelson Nash, who has passed away. Nelson Nash, he passed away last year, is the person that really gets credit for discovering the infinite banking concept. I'm sure that there were other people in his day that maybe were doing it before him, or maybe it was just super like hidden under the radar. Still to this day, you could argue that infinite banking and velocity banking is still somewhat under the radar. It's not as big as the debt snowball concept or the debt avalanche or buy term, invest the difference, just buy regular life insurance. So we're still not seeing on a massive scale this kind of information being spoken about, right? So Nelson Nash, that's his name, and then there's that's like a whole, what is it? Nelson Nash Institute, I think. Yeah. So Nelson Nash Institute, did I spell it right? I think I did. Nelson Nash Institute is a company, made by Nelson Nash, I'm assuming, right? And some other people that helped him. They practiced the infinite banking for so long, and then they started teaching it to other people. And then now they just really made themselves a kind of like a foundational start point almost, where he wrote a book called Become Your Own Banker. So I think that's where we get the term from, become your own banker. You're literally establishing your own private tax-free bank that does not report to the credit bureaus. It's completely private. If you were to get sued or anything like that, they cannot come for that money. So it is super private, and it's a really an incredible product, right? When designed properly. So Nelson Nash Institute now certifies life insurance agents all over the US, and they have been doing it for quite some time. They call them authorized practitioners that know, understand, can sell, can teach you the infinite banking concept and design a policy for you. So it's almost like a credibility standpoint. When you're talking to someone, you can ask them, hey, are you an authorized practitioner of the Nelson Nash Institute? Since that is the guy pretty much that wrote the book, been doing it for so many years. The videos I've seen him in, he looks super old, like in his late 80s. I think he passed in his late 80s. I don't know if he made it to 90, I'm not sure, but he's been around quite some time, and he's been talking about infinite banking for a very, very long time. So you have that, Nelson Nash Institute, and then there's another lady, Pamela something. Okay, Hidden wrote James Nethery, which I think the guy James Nethery, I've seen quite of his content coming up lately. He has a podcast, but also a YouTube channel. And I think he's personally interviewed Nelson Nash a few times and some other individuals. So that's pretty cool. You get like direct access, okay? Let's see, anyone else have any other thoughts? Okay, let me see who's commenting. Okay, all right, so no one's saying anything just yet, other than my friend Hidden, definitely putting some, I'm telling you guys, definitely like comment, like let's look this stuff up. If you do not have a policy yet, you wanna make sure you get the right freaking one. There's a lot of people and there's a lot of information out there. So you have to really dissect things. You can't just go off people's words. You have to really look and search for yourself. And this is what I did before I became a customer, right? Like I went through 3, 4, 5 different companies before I found IBC Global, right? And so you may have done the same thing and you fell somewhere else, right? And you landed somewhere else. And then you started a policy, you've had it for a couple years, and then come to find out, it's not performing the way you wanted it to perform. So from my own personal experience so far, I have been a life insurance agent for over a year now. And of all the policies that I've seen that people presented to me, like actual clients that say, here, I have a whole life policy, I have a cash value policy, here are the numbers. Almost every single time, or I will say every single time, the policy was not designed to what they thought. They thought they could do this, X, Y, and Z. They thought they could fund it this long. Come to find out they can't, or the interest rate is higher than the dividend that they're getting when they take out policy loans. Maybe they're not able to take out a policy loan more than X amount of times per year. So they find out all these things after the fact. They find out, oh shoot, I could have had a policy where I had 90% of my money go towards cash and 10% go towards premium. But when I look at my policy, I see that it's like a 50-50 split or 60-40, or they've got 80%, 90% going towards premiums and barely anything going towards cash. And then they find out that they're not even with a mutual life insurance company, they're with a stock. And you got to know the difference between the two. So when we're looking at infinite banking, there's 3 options on the table. You have mutual. Where can I write that? Here are your options. So your options is you can go with a whole life insurance company that's mutual, or stock. Right? So 1, 2, and then you have IUL, that is not a whole life company. Even though they might sell whole life, they're more on the index day design policy. So technically, a index universal life insurance policy is a whole life policy. You're going to have it for your whole life. You're going to pay into it your whole life. But the way it's designed is, instead of the dividends, the earnings that you would get from this policy isn't coming from the company directly. When you design it, you're having your money grow in the stock market, right? So you're going to get stock market interest rates, the averages, which are going to be typically more than a mutual whole life insurance company, where these guys really have a floor of 4%, and then anything above that would be a dividend, right? So maybe you get another 1 to 2, maybe 3% in dividends from a whole life. But with IUL, they've got numbers in the neighborhood as high as where they have something called caps. I've seen the caps go as high as 15%, even 20% displayed by other insurance agents on their illustrations and whatnot. So you have the ability to earn more money in an IUL policy. Now you have to figure out, okay, what's the cost? What company am I going with? And how do I know it's the right company to go with? So you've got those three options: mutual, stock, IUL, and then there's different terminologies with IUL. Then there's UL, just universal life. And then there's some other names as well that I don't really know of. You guys can comment if you know the other ones as well. But so here's what we do want to look at when we're going to decide if infinite banking is the right time for me, if I'm ready to get this thing going, and I want to, have the right policy for my life. So what we want to look at is obviously the company, financial strength. We want to look at the financial strength of the company, the dividend performance. Okay, we want to look at the dividend performance, the financial strength, their history. You want to look at their history in terms of their revenues, their dividend history. How many years have they paid dividends to policyholders? Okay. We want to look at the flexibility of the company itself. Flexibility. I think I spelled it right. We want to look at the flexibility, meaning behind the actual product, whether I go with IUL, whole life, or stock company, which, when it comes to taking out policy loans, and the performance and how it, performs over the years. Does it get better as the longer I own the policy? Does it get better or does it get worse? Right? So we want to look at the flexibility in terms of how I use the policy. How many policy loans can I take out a year? What is the loan interest rate when I do borrow from myself? Is there an offsetting effect, or does it actually cost me to borrow that money, my own money, right? So we want to look at that. Let's see, we want to look at the MEC limits, all right? This is important. MEC stands for Modified Endowment Contract. MEC limits. This is really referring to the actual policy design, right? So we can write policy design. So even if I found the great company that has great financial strength, great dividend performance, has great history, they've been around over 100 years, they've got great flexibility, but if this is not right, policy design, if your policy is not designed right, then you're going to have a MEC that's not designed properly for you, number one. Number two, it's not going to perform to the company's standards, so to speak, right? Because If it's not designed right, then this thing sucks. It's just not going to function right. Prime example is I had an individual that went with one of the four major mutual life insurance companies, so MassMutual. This individual was putting in $6,000 a year into MassMutual, right? Putting in $6,000 a year into MassMutual, one of the majors, one of the four majors, and his cash value year one was zero. Zero. What the hell? So he had nothing in cash. I think he had $12 or something like that. It was ridiculous, right? Had nothing. And you're wondering, well, how could that be? The company is considered one of the four major mutuals. MassMutual is ranked 84 on the Fortune 100 list. So they're, out of the whole United States, MassMutual is ranked 84 in terms of their revenue, financial strength, and some other factors, whatever it takes to get on that list. That's a big list. That's a nice list to be on. And you mean to tell me that this great company that has a great dividend rate, a great flexibility, their history is awesome, they have great dividend performance, their financial strength is superb, they're a AAA rated on the Better Business Bureau, but here you got a client that's putting in $6,000 a year into MassMutual and they have zero cash value. So that means that this right here is everything. Really, that's the case. That's really everything. They designed a policy for life insurance. When you're looking at infinite banking, we are not designing the policy for life insurance. We could care less about the death benefit. We care everything about the cash value. How much cash do I have day one, year one, to start using to my advantage? So another example is I personally have a client that's putting in $6,000 a year, right? And her starting cash value after 1 year, it took her the whole 12 months, I believe, to fund it, because she broke it up into monthly payments of $500. So her cash value, I believe, was like $4K plus, a little over $4K. I forgot, in the first year. But that's a lot more than zero. Would you agree? Of course, because she had her policy designed correctly by the insurance agent. So that is one last thing that we need to also consider, is the agent themselves, because the agent is the representation of each company that we're looking at. So Northwestern Mutual, Security Mutual, Penn Mutual, Lafayette, Mutual Trust, MassMutual, Guardian, New York Life, all of these companies do not sell the infinite banking concept. They do not sell it personally. The agent does. So you got to find the right agent, right? You want to start there. You got to find the right agent that is willing to work with you, help you, and design something that's correct, something that's right, something that's going to benefit you more than it'll benefit the agent. Right? It has to be a bigger win for the customer than for the agent. Because if the agent is winning and the customer is not, eventually, it'll fold. But unfortunately, a lot of people will have these poorly designed policies. So we want to avoid that. So the agent is really above everything, and then the policy design. Okay, the agent represents the company that you're working with. Agent does the design of the policy, not the company themselves. The company is just providing the product and the resources and the everything else, the strength, performance, all that good stuff. So, any questions so far based on what I've said so far? Anybody got any questions or any thoughts? Anything you want to add? Be sure to comment, even if you're going to watch the replay on this. Comment, because I want this video to be like a place that we can build on, and maybe I'll make a playlist and we can just keep expanding on all this and figure out, okay, which company do I go with, man? Which one makes the most sense? The most sense. So according to Mr. Ramos, there is another agency out of Jacksonville called Your Family Bank. They use mutual trust. So I have them on the board. Your Family Bank, that's pretty popular. We'll put that over here on the terminology. I've heard that company before. I think they're doing something very similar to what Nelson Nash did. Is they're also certifying life insurance agents to teach them the infinite banking concept, to provide, the products to them, and I think they're practitioners as well. So you're gonna have different organizations that are gonna copy what Nelson Nash did, because he did something just incredible. Okay, he's brought something to the light that has just been hidden for so long. So you've got Your Family Bank is going to be doing the same thing. I'm pretty sure IBC Global is doing the same exact thought process of, really certifying individuals. I mean, the person from IBC Global, his name is Steve Parisi, and he is an authorized practitioner of the Nelson Nash Institute. So he does have that credibility. I don't know if VIP Financial or Wealth Nation has that. I'm pretty sure Your Family Bank does. So there's that. So coming back, just to recap here. When we're looking at infinite banking, got to look at the agent first. Who you're working with, what broker, right? Policy design, how is your policy being designed? It should be in the neighborhood of a 90-10 split. So if you're going to go with any one of these companies, as long as you do this, right, and you find the agent that knows how to do that and can display it properly to you and show you so that you understand, and they walk you through that policy contract so there are no surprises, right? Then you could typically have a pretty good policy. Maybe it wasn't with the best company, but really the design is key. It's critical in terms of your cash value performance. The more you have in there, the better it'll perform, okay? So you want to have that 90-10 split. If you see a design that is, I would say, more than this 70-30 split, if you're seeing something like a 60-40, a 50-50, a 40-60, right, where it's like now you've got 40% of your cash going towards cash value and the other 60% going towards premium, you are getting closer and closer to having a policy designed for life insurance where you get the most death benefit for the least amount of cost, right? Where we're trying to get the least amount of death benefit for the highest amount of cash value I can possibly put into a policy, okay? So now, let's go over the 4 major mutuals. Now, according to IBC Global and the education that I received from IBC Global, they make the claim, right? And they're able to back it up that these companies right here is what he calls the 4 major mutuals. I like how he says it. He always says it in like every video. The guy says it. It's like redundant. It's awesome. So he says MassMutual, Guardian, New York Life, Northwestern Mutual. Not in order. It's not in order. But these 4 companies have historically performed. They've been in business for over 100 years. They have the highest dividend rates, crediting rates, their financial performance, the flexibility, their MEC limits, the agents, the policy design. These are the top companies. And then so the numbers that I wrote right here are the current dividends for 2020. So 2020, MassMutual is doing 6.2%, Guardian's 5.65%, New York Life is 5%, Northwestern Mutual was 6% in 2019, and in 2020 they have not displayed their dividend rates just yet. I'm sure they will soon, but I'm assuming it's going to be fairly close to the 6% mark. So you have those companies, right? And I took some notes. And so I said earlier that MassMutual is they're number 84 on the Fortune 100 list. You've got Northwestern Mutual is ranked number 111 on the list. Did I do the other ones? My data is incomplete, but that is okay. That is okay. So let's see. Let me see real quick. Go to the Fortune 500 company, and let's see where New York Life sits. So New York Life Insurance Company. They're also a AAA rated. So they have assets under management as of 2017, so that's 3 years ago. So as of 2017, they got 585 billion assets under management. So that shows a lot of financial, performance, financial strength. And that's of 2017. I wonder what their numbers are in 2020. So we'll find out. And definitely comment below. Everything that I'm saying, just if you're finding information, drop the comment, right? Drop the comment. Okay, someone's talking about, let's see. So we got Living Wealth. It is a Nelson Nash practitioner. So Living Wealth. I think there's another company called Wealth Paradigm. I spoke with them before. So you got Living Wealth. According to Keith Perry, they're also part of the Nelson Nash Institute. Can you guys see that on the board? Yeah, you can. Cool. Because I know it cuts off at a minute. You can't see the bottom. Living Wealth. And then you've got Wealth Paradigm. I'm going to call them Wealth P. I don't want to spell paradigm wrong. Let's see. How much do agents get paid off of policies? Question from Billy. Okay, cool. That's an interesting one. Make sure I'm not skipping any questions here. Hidden says Oregon Cash Flow Pro, another channel. Yes, it's a newer channel, kind of like me. So I kind of wanted to go over like the channels that are bigger. They've kind of been around a little bit longer, but we'll put them up there for sure. Now, LIEN Man, another good channel. Okay. Yep. Antonio says Paradigm Life. Yep. Okay. Let's see. I'm seeing an agent next Saturday from Northwestern Mutual. Should I make sure I receive in terms of cash value in the policy? I'm 53 years old. Okay. Should I make sure I receive in terms of the cash value in the policy? I'm 53 years old. So what is the question? Right? So you definitely want to, you see this agent and you want to ask them, okay, what are you designing for me today? What are we talking about? Are we talking about life insurance or are we talking about infinite banking? Let's get something straight here, right? Because the agent is going to make something according to what you say. So if you don't really know about the infinite banking concept, then it's kind of tough, right, to actually ask the right question because there's so many questions, there's so much data. I mean, look how much videos I did on velocity banking. Look how much videos are out there on velocity banking. When it comes to infinite banking, it's the same thing. There's so much information. So some critical questions to ask. What is my MEC? Okay, what is my MEC? With whatever illustration they provide you. How much am I putting in per year into the policy? How much am I putting in per year into the policy? How long am I funding the policy for? My whole life? Period of time? A short period of time? Minimal, medium, long? What's that? The period of time funding. How much am I funding? What is my MEC? What do I have the ability to fund into my policy? What is my max MEC, my max ability to put into that policy each and every year that the policy is in force? It's good to know that number, that max number. What is it? And then the dividend. What's the dividend rate? What company? We already have that, Northwestern Mutual. You're in the 4 majors, so you're pretty much kind of beating in terms of financial strength, performance, dividend rate. You're beating these guys because of the amount of strength, assets under management. So Northwestern, look, they're ranked 111 on the list. Type in any one of these companies and see where they rank. Help me out, guys. Let me know because I left some space here to try and get some data. And I wrote some stuff so far. So, One America, I wrote they've got 77.2 billion in assets. That's pretty good. That's very high according to my research on other companies that I've seen. So here's Security Mutual. They only have 2.77 billion in assets. They've paid their policy holders only $21 million in dividends. Okay? So that seems like a tiny baby company to me. If you got a company right over here, 585 billion, how many times can New York buy Security Mutual? A lot of times. So there's that. You've got Ohio National Financial Services, 39.3 billion. Okay, they're a little bit bigger. All right, and then you got One America. One America so far is like on my radar because they're pretty interesting. They have very similar assets under management, very similar to Guardian. So that's why I was like, very interesting. See how their performance is, and I'm gonna keep doing research. LaFontaine, be sure to ask those questions. You're 53 years old. And then this right here, the split. That was the last one. What is the split? You just simply say how much money is going towards premium and how much is going towards cash each and every year in the policy itself. Okay? And then we got Big Big asked the question, please explain the MEC, Modified Endowment Contract. So the MEC, okay, right here, Modified Endowment Contract is a 7-pay test, okay? So I'm gonna write that over here. Okay. So we got the MEC is a 7-pay test. It is a IRS, IR and the S, like GC says. The IR and the S. It is an IRS limitation. Okay? When you are designing, getting a policy designed for yourself based on the infinite banking concept, you still have to buy life insurance. So the IRS says, hey, this is the only asset that the IRS will not tax. You will not have to pay taxes on the gains in the policy if designed properly. Okay? If. You got to make sure that design is right. Because if it is not right, the IRS can say, hey, you designed a policy that's going to MEC out in year 15. So let's say you've been funding it for 14 years or whatever. And then according to the MEC test, you're going to MEC out in year 15. And you know what will happen? You'll have to pay taxes on all the gains, and you'll get penalized, and it'll function like a 401k in a sense, right? So you're going to get dinged really, really bad if your policy becomes a MEC. Something that you can do if you already have a whole life policy or IUL is you can read your contract and or call the insurance agent that made the policy and work with them together and see, hey, is my policy going to MEC out at any time during this funding period? And the contract will tell you. It'll say this policy will become a MEC in year 33, in year 27. And it'll also say this policy, according to the illustration, will not become a MEC. So you want to make sure your policy says that. Will not become a MEC. Very, very important. That can mess up the whole thing. You could have the best design, ready? You could have the best design, the best agent, the best company, but if your policy is going to MEC out, you, my friend, are in for one hell of a ride when it comes to your finances. You will be highly, highly upset, right? And you know what? You can't do jack about it because you signed that contract. That is a contract between you and the insurance company. And you signed off. I am willing to get a MEC, right? Because you didn't read your contract. Most people will not read their contract because it's 160 pages long of redundant data. And there's really maybe like 10 pages you really need to pay close attention to, which is the costs, the fees, what am I funding, is it a MEC or not, da-da-da, right? So that's the MEC. 7-pay test, the IRS limitation. It's like a benchmark to see, okay, he's putting in X amount of money. Based on how much he's putting in, he needs to keep paying for life insurance. Because the way you become a MEC, the way your policy becomes a MEC, is if your death benefit is lower than your cash value that's in the account, right? So if your death benefit starts to, let's say it started out at $1 million and your cash value started at 10,000. And then throughout the years, it builds, and all of a sudden, you've got $1 million death benefit and 1,200,000 or 1 million. I think once it goes over $1, I'm assuming. So once it breaches If the cash value breaches the death benefit amount, boom, you've become a mech. You've mech'd out, and now you have to pay taxes on all the gains in there. So now, remember how I was saying, if designed properly, tax-free. Well, when it's not designed properly, you're going to pay Uncle Sam. And you're going to be pissed off. And then you know what sucks even more is majority of insurance agents are older, so they might die. So they'll die before you can even argue with them. They'll be in the grave, or one or the other. Someone's going to be in the grave soon, right? Because you funded it for so many years. You worked with an agent that was 50, 60 years old, and God forbid something happens to your agent, now you're out of luck because that was your only point of reference. That was your only contact. And remember what I said, the insurance company, they're going to say you signed the contract. That's between you and the company, not even the agent. The agent won't be on the hook. You signed the contract. You were okay with it, right? So you want to make sure that. Very, very critical stuff here, okay? Let's see. So back to the question of Billy's question. How much do agents get paid off policies? So let's take a look at that as well. And this will vary with the different companies, okay? Different companies have different payout structures. So to keep it general, I don't want to give a number and be wrong because, like I said, it will vary from company to company in terms of how much. But how they get paid is what I can answer is all life insurance agents receive commission. Did I spell commission right? Commission? I hope so. They receive commission and bonuses. And then residuals. Residual. My goodness. I gotta go back to school. I don't know how to freaking write. Commission, bonuses, and residuals is how all whole life insurance agents get paid. Okay? So the commission rate will vary, the bonus will vary, and the residuals will vary. But basically, the commission comes from the premium. So this goes back to the design. The agent will get paid if they designed a policy for you that's a 90-10 split, that's the best you can get. You can't go no higher than that or else you'll become a mech. Okay? So that's the standard right there. So 10% of whatever amount of money they put in. So if they put in 50 grand into a policy, the insurance agent will receive a commission based off $5,000. Boom. Then there's a bonus. Some companies have different, I don't know how they do it, but that's in there. And then there's so I'll do one company being MassMutual and Guardian. I believe both of them is the same number. 2% is paid to the insurance agent based on the amount of money that went into cash value. So 45,000, right, from that example, right? Put 50K in, 5K, the insurance agent gets paid off the 5K. The other 45 goes into PUA, rider, paid up additions rider, and then they'll get a 2% residual on that money. And they'll keep getting that residual every year for, I think, 10 years. Again, it might be different with different companies, but I'm almost certain with MassMutual and Guardian, it's 10 years. So that insurance agent will get 2% pay off your cash value every year for 10 years. Now, this money that the insurance agent is getting paid, it's not coming out of your 50, okay? Your 50 is going with the company, whoever you chose. The company pays the agent based off what the customer gave the company. So by no means, this isn't like when you give your money to a financial advisor and you give him 100 grand and his fee is 5%. So you would get charged 5 grand. And then 95,000 gets invested in the market, and then you have other fees that will chip away at that money. So with life insurance, it doesn't work like that. If you put in 100,000 in a policy, all of that 100,000 will be in the policy. You'll pay your premium, you'll pay your term life insurance expense, you'll pay your PUA rider fee, and any other costs associated if there's other costs with the companies. And then the agent gets paid separately from the company themselves. All right. New York Life shows they ranked 71 on the prestigious Fortune 500 list in 2019. That's pretty cool. So, New York Life, 2019, number 71. So you can see how these companies are really they're like flip-flopping. They're giants. Let's just put it that way, right? Each one of these guys are giants. So they're all doing very similar. You can tell, so 111 is not too far from 84, 84 is not too far from 71. If you're even on the Fortune 500 list, you're basically like a giant, I would say, right? If you're on the Fortune 100 list, you are a mega giant, okay? If you're not on the Fortune 500 list, like maybe some of these companies here on the other side of the board here, then they're maybe a good company. I'm pretty sure they're good companies, but they're not giants. So you can see the vast difference in where you should put your money when putting a policy together. So, see, we got another question here. How, according to Sharonda, how is one of the big four selected over the other? Question mark. It seems like the highest dividend may not always be good. The situation. You got some grammar there. You gotta help me out. Please share the factors that come into play. Thanks. Yeah. So, Sharonda, I hope you're listening to me because I kind of laid it out right there. We got the dividend rate, the history, the performance, the flexibility. Come on, yeah, pay attention. Years ago, there was Bank on Yourself. Oh, you're right. Are they still in business? I'm pretty sure. That's with the Pamela, I think is her name. That's like the face. So Bank on Yourself. Okay, bank on yourself. That's another term that they use. So MassMutual, all right, according to Hidden, 93. That, I don't know, 93, that might have been in a different year. I think the year I was looking at might have been 2018 or 2019, I forget. So according to Billy, he's answering Sharonda's question. They're the big four based off historical performance. The other companies really don't provide those numbers yet, or at least that's what I heard from IBC Global. Yeah, that was another thing. This is tough because you have companies that display things, and then you have companies that release data, like they release information. So they'll actually show you a real policy from a real person that funded a policy and got paid dividends. Some companies will not do that. They'll just say, we paid this much in dividends. We paid this much to our policyholders. And this is important to note. So if you have, where do I want to write it? You know what? I'll write it over here. If you have a company that says that, we paid X to policy holders, okay, policy H, policy holders, you gotta be careful with that because they could be referring to the death benefit, not the dividends, or they could be combining both numbers. So if you had a company that says, we paid $5 billion to our customers, to our policy holders last year. $5 billion what? $5 billion in dividends or $5 billion in death benefit? I would surely believe that if they told me death benefit and dividends. That would make sense because some people have really big death benefit policies, right? 1,500,000. How many people die per year that have life insurance? We could find that out. We can look that up as well, right? So you want to be careful when you're looking up the information. Let's try and find out. And then if you're talking to an insurance agent and they say, yeah, we paid the most dividends to our policyholders last year. We paid the most amount of money to our policyholders last year. You want to make sure, hey, was that dividend? Or are you talking death benefit? Or are you just combining the numbers? If you combine the numbers, then you're not really getting the correct information. And then you should always ask for a real policy. Like, here's the other thing. When you're working with an insurance agent, the design, the illustration, those are all fake. So don't go off what the illustration is being provided. So when I talk to my clients and I provide them with an illustration, I tell them right up front, I'm saying, hey, these are fake numbers. These are not real. These are an illustration of what the policy may or may not perform. So let's be very clear. So when you're talking to an agent, ask them that. Say, hey, are those real? If they say, yeah, with the little, with an accent, yeah, it's real, right? They do this, hey, it's real. It's real. It's a piece of paper, it's real, right? Don't get fooled. Don't get fooled. All illustrations are fake. They're just showing you what could be. It could potentially perform this well. It also could not. So when you're looking at an illustration, it's nice to get the guarantees and the non-guarantees. Some companies will do guarantees, non-guarantees. They'll do a low performance, they'll do an intermediate, and then they'll do a current. So based on their current dividend scale. So what they'll do is so let's say you get a design with MassMutual in 2020, your illustration is going to illustrate a 6.2% return even after the fees and whatnot. It's going to show all those years, right, of the performance. But there could be some years that you're funding that policy where the 6.2 will no longer be 6.2. It might drop to 6. It might go up. It might go down. But it'll never drop below 4. So that's a good thing to know, is that you get that 4% floor no matter what, right? And that's another good thing to find out is what is the floor, right? With these companies, the floor is 4%. With others, their floor might be 2, might be 1, might be 3, might be 0. So you want to get that information, okay? Let's see. Okay, Ruben's helping out. So Guardian Hidden says, Guardian 239, and then you wrote Guardian again, number 93. So you're going to have to help me out there, Hidden. So I think I agree with you on the second number. Guardian, I think is ranked 239. I think I would agree with you on that. I think I would agree with you on that because I think Guardian, out of the four, in terms of assets under management, Guardian I think is the smallest out of the four, if I'm not mistaken. I do believe that is the case. And then Ruben does say, okay, big anything doesn't matter unless the policy design is right. There you go. So it just kind of goes right back to that thing, it's got to be designed right. So Billy says, nothing wrong with the smaller companies. I would agree on that note. Nothing wrong with these companies. They're just smaller companies, right? Each company has their niche on who they serve, has their pros and cons. So it's just a matter, I think really it just kind of boils down to the agent and the policy design. And then obviously, if you're with the four majors, I think it provides that little bit of security. Like, okay. If I go with Security Mutual, I don't know, they could get bought out by New York one day. And then what happens? Does my policy change, or what if they go out of business, or what if they merge with another company? Will my policy still perform the same? I don't know. So these are, I'm very curious. I'm an insurance agent. I do sell the infinite banking concept. I present it to my clients when they're ready, when they want to do it. But I am still a curious human being. I'm very curious. I'm willing to be wrong. I'm willing to make mistakes. I'm willing to say, okay, maybe that policy isn't the right one for you. Okay, maybe infinite banking is not right for you. I don't know, But I'm going to keep searching. I wish I could just say, all right, I want to put 5,000 with Penn, 5,000 here, 5,000 there, and I might do something like that when I get a little older. Is I might just buy a policy with a random agent, right, and see if they design it right for me, fund it, and then compare it to the four majors, and then have something to show for 10 years. And I think that's the advantage that I have over a lot of other agents that are much older that are selling the concept, is I can say, hey, here's a 25-year-old and a 25-year-old male putting in the same amount of money for the same amount of time period. Let's see who performs better. It's like you never really know until you buy the thing. And I think that's what sucks the most. It's like you could have all this data. You could have it all. But then it just boils down to you, the agent, and then you actually putting the money into that policy and actually funding it and actually sticking to your commitment. I want to put $50K a year. I want to put $100K a year. I want to put $10K a year. Sticking to that number is going to be key. Because if you put $10K a year and then for the next 5 years you're only putting in 5, guess what? You're going to have a poorly designed policy, right? But if you have the ability to make up contributions to that policy, then that would definitely help your performance quite a bit. All right. Let's see. Billy says, officially starting my first policy today with Guardian. Woo woo. The day has finally come. It has been a journey. Yes, Mr. Billy has been working with me for about a year now. Pretty cool. Okay, 2018 Guardian was ranked 239. So that number might be different. Maybe better, maybe worse. And Rich, when we're talking about rank, we're talking about the Fortune 100, Fortune 500. Let's see. Someone said, I need to become an agent. Yeah, it's pretty cool. Becoming an agent, it's like a no-brainer if you're someone that loves this stuff. You love infinite banking, you want to get your whole family and friends on board. Why not? Why not? That's free money, right there. I mean, this concept is a no-brainer. It's just getting through the weeds, right? And getting through all the crap information that is fed to you, okay? So really trying to dissect all of it first and get the education. Totally worth having a nice stream of income. And that's what I did. I was like, you know what? This infinite banking concept is great. Because before infinite banking, all I knew was velocity banking. And I thought velocity banking was great, just alone. But then when you combine the two, oh my goodness. And the two work great with each other. Let's see. Any agents in New Jersey for a dividend paying whole life? I don't know. I think if you go to Nelson Nash Institute, you could actually like put your zip code in and get connected with a authorized practitioner of the infinite banking concept. But remember, find out what companies they're working with, figure out what, like just ask them to design you something and let's see where their head is at. See how they design it, you know? So this is kind of like an interesting strategy as a customer is you want to, you know, kind of like not give them too much information, but, you know, you be honest. Hey, I want to put $10,000 a year for 10 years. Can you design me the best infinite banking strategy that's going to maximize my cash value for the most amount of MEC that I can get for that number? And see what they make you. If they make a policy where it's a 70-30 split or 60-40, 50-50, hey, maybe they're not the right guy or woman, right? But if they give you a 90-10 split right off the bat, you might be onto something, right? Now it's just a matter of, okay, once you get the split right and the design, now you want to figure out how do policy loans work? How does the interest accrue? Simple interest, amortize, simple interest, amortize. How is that interest being accrued? How does the underwriting work? You know, when I want to put more money into the policy, do I have to go through underwriting again? Is there any restrictions? How fast can I get access to the money? Do I have to wait a year, 2 years before I can actually borrow from the policy, right? Ask these questions. Then you want to ask, what year does my money break even on the policy itself? Typically, you want to have your cash value break even in years 3 to 6, maybe 7, 7 being the latest, 3, 4, year 3, year 4 being like the earliest, year 7 being the latest. Now, break even meaning if I'm putting 50K in, at what point does my cash value represent the amount of principal money I've put into that thing, right? Once you do that, then you want to ask them, what is the internal rate of return, or IRR? That's a terminology I've heard in real estate quite a bit, so it applies here as well. And it applies to your 401k plans and everything else. They say 6.2%, they say 6.5, 5.5, whatever the rate is. But then what is the actual internal rate of return on the policy itself, right? And that internal rate of return will be less than what is displayed by the company. Because after cost, then what did I get? And that's with anything, real estate, your business, 401k plans, retirement plans, financial, all that. It's all the same. What's the internal rate of return? And that will help you also determine how reasonable the dividend rates are being displayed, right? Compared to other companies as well. Let's see. Cruz says, what's the criteria to become an agent and how long does it take? I would say maybe 2 months, depending on how much free time you have. There's a 40-hour class that you have to take, and then there's the state test, whichever state that you're in that you have to take, pass it, right? Once you pass, then you get appointed. You have to find an agency to get appointed with, and then boom, then you're on your way. Okay. Let's see. Rich says, the best thing about these policies is the loan concept. Being able to use the money while it still grows is key. As far as performance on the money in the market, you can beat it easily. Nice. Yes, this is very true. You can totally, if you were to compare a 401k plan to a infinite banking plan, you would get very similar results. Now, there's no doubt that the 401k plan would technically earn more money, right? Over the years, it would, because it has the ability to. Might get a 10, 15, 20% return, who knows, right? But when you break down the cost of investing your money in a 401k plan, and then you factor in the taxes that you have to pay when you start getting distributions from that money, and then when you factor in the flexibility of the account, when can I actually use, I can't use this money till I'm 59 and a half, technically, right? If I get a loan, yeah, but it's a loan and it's not revolving, I have to pay off the loan in full before I can take another one out. Maybe I can only do 2 loans per year with a 401k. So you have a lot of restrictions there. But when you look at the actual performance of an infinite banking strategy versus a 401k plan, and you really matched it up, you guys would be really, really, it would pique your interest to a point where you're like, should I really be funding my 401k till I'm 59 and a half? Or if I'm 40 years old, I'm 45, I'm 35, should I consider maybe transitioning my 401k to the infinite banking? That might be a strategy in it of itself, where you could have the money now grow tax-free and have a death benefit and be able to use the money today. To do what, guys? Pay off debt, increase cash flow, lower expenses, build your income and wealth. Pretty cool, right? Let's see. All right, I think I answered most of the questions here. Okay. So yeah, I'm gonna leave this video public and I'm gonna spread it because I really want to make relationships with other infinite banking people and say, hey, why are you doing Penn Mutual? Why are you doing Lafayette? Why are you doing Mutual Trust? Like, show me a real policy that's doing what these guys are doing. Let's compare and contrast. I'll show you my real policy, you show me yours, and let's see can we help the people that are trying to learn this stuff for real. And even if you stay with the company, can you at least make sure that you're doing a 90-10 split? That's all I ask for other infinite banking agents that are out there selling policies. Hey, can you stick to 90-10? Can you stop selling 70-30 and 60-40 and 50-50 to 50 and 60-year-olds? That's not fair, right? Especially if they're just trying to design infinite banking. If that 50, 55, the 60, the 65, the 70-year-old, they do not care about the life insurance, about the death benefit. They're more concerned about wiping out their debt, getting their cash flow up, leave something behind for the kids, yeah. But they would be more happy if all the debt was eliminated and they still had access to the cash to use it as they please, okay? So this is like my message to all other infinite banking agents out there, right? And I know with IBC Global, Mr. Steve Parisi, he's the same way. He's like, look, even if you don't go with us, at least get a policy designed by the 4 major mutuals. He's like, at least do that. And then if you don't, and you go with other companies, at least get them designed right so that at least it'll perform pretty good, right? Don't get no crazy 60-40, 50-50 split because it's gonna mess you up, right? And you're gonna be disappointed when you see your cash values not performing at the standard, at the rate that you thought. You thought you was getting a 6%, 5% return, but in fact, it's the IRR is what you're actually getting in return. So you wanna look at that, and then you wanna see when you're breaking even and all that good stuff. So this is all really good. Yeah, okay, Mr. Eli just joined the live stream, so yeah, you'll have to kind of wind back, and because I went over your question earlier. So let's see. I think we'll end it here. Does anyone have any other questions? Before I go, I'm gonna give you about 20 seconds. Type your question in. Was this great? Was this helpful? I think it's a start, okay, in terms of what company I should go with, who should I know, like, and trust, how do I get the design properly, and then what are my options? I can either go with a mutual life insurance company, a stock company, or I go with an IUL or UL policy that has my cash value grow with the market, with like the S&P 500 or something like that. So those are your three different options, and you can match it up and see, can this work for me personally? And we'll go from there. Okay, love it. Hidden says love it. Joy says love it. Okay. Rich says 2 days in a row, Denzel, you the man. Thank you, sir. All right. Hope you guys enjoyed this. This was good. Please, I'm telling you, leave comments. Let's research this. Find the companies that find the assets under management. Okay. This is what we need to find. AUM. All right. Assets under management. Their rank. Are they a AAA, AA, A rated on the Business Bureau, right? What's their rank? Time in business is always good. And then you want to get real data, not presented data. You want to get real data on dividends. The company says that they did X, Y, and Z, but what did they actually do? All right, let's look at can we get a real policy and see what the actual results are, okay? And then you want to look at this, IRR, the MEC limits, right? And these are for people that are getting policies designed, right? The MEC limits. Try and get all of that from your agent. That's the person that should have most of this data, if not all. They should have it because they're selling whatever company they're working with. So they should be informed to a degree. All right, maybe they don't have it all, but they have most of it. All right, so let's figure that out and just make a nice big comment below so that when people watch back, they can see this and they'll get really, really educated. This will be super cool. I'm being very transparent here. I'm not saying anything other than just trying to display facts, right? And then we'll go from there. All right, so I hope this was super, super helpful for you guys. God bless. Have a wonderful day.